The outlook for tech is looking shaky for 2023 as the investors and the industry, they are lowering the bar for earnings, and companies continue to lay off workers amid broader economic headwinds. Here to discuss, we've got RBC Capital's Managing Director, Rishi Jaluria. Rishi, great to have you here with us today. First and foremost here, when you look across some of your coverage and the companies that have still yet to lower some of their earnings expectations, is the cloud in trouble broadly here as a trade?
Yeah, and thanks for having me. Look, I don't want to say the cloud is broadly weak as a trade. I think you hit on it though, right? What is really important is everyone wants to see numbers get lower, and the issue with a lot of these software subscription companies is the slowdown shows up on a lag, right? And so even if there's internally weak bookings numbers, it may not show up on the revenue line for 3-4 quarters, right? We've seen that happen time and time again. And there is still a lot of feeling of optimism at those companies that they're going to have a strong Q4, because Q4, which is going on right now for everyone, is kind of make or break for most companies. So it may take another, 1 or 2 quarters before we really start to kind of see numbers bottom out. And that's when I think the whole sector becomes a lot more ownable, is because that's when you start to get that upward revision to estimates again.
Hey, Rishi, it's Julie here. I mean, as we look across the sector and across your coverage for that matter, a lot of the companies reported earnings after the close yesterday. There is some differentiation, at least in how the market is reacting to some of these. I mean, I look at the likes of a Smartsheet, which at least when we checked earlier was up on the day, and it seems to be perceived as doing better. Like, what is going to differentiate these companies in this challenging environment? How are some seemingly managing this better?
Yeah, I think Smartsheet and there's a couple others have kind of given a playbook for what you can do, right? Which is be really conservative in your assumptions, right? Don't just assume that macro stays the same, and definitely don't try to hide a slowdown. I think we've seen a number of companies say, oh, we're not seeing a macro slowdown, and then suddenly you actually see it happen, right? We've seen that happen with a number of names, most notably Smartsheet's competitor, Asana, which also reported last night as well. And Smartsheet has been upfront about some of the macro challenges they've been facing, and they're actually modeling in that macro gets worse, which is what we think is going to happen as well. So I think that's kind of the playbook that more and more companies need to follow, is adding in an extra layer of conservatism in numbers beyond what's already out there, and that helps give investors more confidence that numbers aren't going down, estimates aren't going down.
So this would typically be a time, especially on lower valuations, that we might see more deal making move forward. But it's also at a time where there's a very kind of cost conscious restructuring that's taking place at many of these companies too. And so does that mean there's less of the acquire to grow strategy that will be enacted, or perhaps is there still some kicking the tires and deals to be done?
Oh, we definitely think there's a lot of deals to be done. The fact of the matter is we've gone through this era of SaaS sprawl for the past, decade, right? Where your average enterprise has more than 1,000 SaaS applications, and that's probably not the right way of doing things, right? I mean, platforms are what's going to win over time. And so we do expect that consolidation to happen, especially for more point solutions that should just be part of a larger suite of platforms. It hasn't happened yet. Most of the M&A we've seen has been in private equity land. But look, I wouldn't be surprised if we start to see the large platform vendors, especially once they have kind of confidence in the market and then valuations kind of bottoming out, especially when private valuations also correct, because those haven't corrected yet. It's only been the public valuations that have. I think we could see a lot of the larger software vendors turn into acquirers and start to consolidate the market and consolidate budget.
Rishi, finally, I got to ask you specifically about the largest company I believe that you cover, which is Salesforce. Is it a problem that Mark Benioff keeps chasing away his co-CEOs, and do you want to own the stock here?
Yeah, so that's the second largest company I cover. The largest one is actually Microsoft, which is one of the largest in the world. But yeah, no, when I think about Salesforce and the co-CEO structure, look, we've always kind of been believers that co-CEO is a really difficult thing to do, right? Unless it's a situation like Atlassian where the co-CEOs are co-founders. It's really tough, right? You need to have someone who's kind of the head making all the decisions. And so, we've seen twice now Salesforce try to do the co-CEO structure, first with Keith Block and now with Brett Taylor. And it just doesn't appear to have worked out long term. There's always the thought when these co-CEOs get announced that Mark is kind of going to work on his successor, and this is a step one in succession planning, but that just hasn't panned out, and so I wonder if the next move from here is does Mark Benioff try to find another co-CEO and try to groom another successor so he can focus more over time on philanthropy, which is probably his true passion, or does it mean that he might just kind of say, I'm going to go at this alone and I'm going to be in charge of this and not dabble in the co-CEO structure? In terms of the stock, I do think it is ownable here, right? I mean, we talk about what's going to happen in a downturn. Salesforce can definitely consolidate budget, right? I mean, they have so many different solutions across the sales and marketing and collaboration stack. And so they can get a lot more IT dollars over time, especially in a downturn where CIOs are looking to consolidate vendors and tighten belts. And it feels like Salesforce has a lot of room for margin expansion, a lot of room to improve their profitability. And it feels almost like a self-help story at this time. So I do think the stock is ownable, especially at, sub 20 times free cash flow.
All right. Rishi, really good to catch up with you. Thank you so much. Appreciate it. RBC Capital Markets Managing Director Rishi Jaluria helping us figure out how to navigate software stocks going into the new year. Thanks.